So many investments are now at all-time high. Well, the market really looks promising for many people in 2025, right? So many people are now talking about jumping onto the investment train. The market is getting hot again. Well, whether you're a beginner or you're an experienced investor, the issue is this: how do you start investing without feeling overwhelmed? So if you have been asking yourself, is there a way that you can invest in a simple, easy, and effective way? Well, today I'm going to show you a tested and proven way of doing it. So right now, we are in the beginning of what it seems like a bull market. But even at this point, investing can be quite tricky. You don't want to be making the wrong move at the wrong time, right? A lot of people say, buy low, sell high. But what many people do is they buy high, sell low. Guess what? You actually do not need to be a stock expert or a great market timer to succeed in investing. So there's a strategy that even an experienced investor like myself really have been using it for a long time and even swear by it. That is the dollar cost averaging strategy. I would say it's probably the best strategy for anyone who want to invest and don't want all the headache. Here's how it works. It is really simple. All you need to do is just invest a fixed amount regularly, no matter how the market is doing. So whether the market is soaring or the market is tanking, you're still going to invest the same amount on a regular interval. Whether it's every week, every month, or every day, whichever that fits your schedule. Now, it sounds really simple, but I can tell you that not many people are able to do it, because tomorrow when you go out to a coffee shop, makan with your friends, and suddenly they tell you, hey, this thing is going up, you should take opportunity, invest more. Then you may feel that FOMO-ness again. So honestly, it is simple, but it is not that easy to execute because of emotions. Now, before we go into talk about dealing with those emotions, let's spend some time to understand why dollar cost averaging works in the first place. Firstly, it takes all the guesswork out of investing, which means you do not need to worry about the timing of the market or predict what is going to happen next. Over time, DCA simply average out the highs and the lows of the market. You don't risk putting all your money in at the wrong time or even at the right time. It just averages out. You see, comparing this to someone who tried to invest a big lump sum at one point in time, you're going to be always worried whether are you investing in the highest time of the market or the lowest time of the market. As you're worrying, the market is going to continue to move, right? So nothing's going to wait for you. So as you're thinking about it, that, oh, this may be the right time, then tomorrow morning, the market go up or go down already. Then you need to rethink again. This is really troublesome and cause a lot of headache. And since you're only investing one time, it means you only have one chance to get it right. Comparing to dollar cost averaging, when you invest over a period of time, in a regular period, you are spreading your risk out. Another thing I want to highlight is, many people when they talk about dollar cost averaging, they think that it's an investment strategy just for beginner. So if you're experienced, you shouldn't be using it. Well, that is not true. Actually, even seasoned investors like myself use DCA. Why? Because it works. The longer I've been in the market, the more I learn one thing. I never know when's the highest or the lowest of the market. I may understand trends, but there is also a high chance that I can get it wrong. And since it's impossible to get it right consistently, why not just invest steadily over time at regular intervals? This way, there's much higher chance that I can catch the market at the right timing. So yes, that itself is a diversification. But instead of diversification over multiple assets, you are talking about diversification over timing. Remember earlier we talked about one of the biggest enemy of investing is actually emotions? Yes, many investors actually lose money investing simply because they can't handle their emotions, whether they're beginner or they are experienced investor. And here is where DCA truly shines, because it helps us to take away emotions out of the whole investing equation. Now, think about it, it's more than just a strategy, but a system in investing. Instead of needing to deal with the different emotions that comes up whenever you see a news and trying to make prediction at every point. On top of that, people like us who are not full-time investors, you got to deal with work, you got to deal with family, you got to deal with so many things. With all those emotions added together, then suddenly one news come out and then you need to deal with investment punya emotion. Walao not easy, right? And this is where, when you are using DCA as a system, you forget about all the emotions. You just follow the system, keep investing on a regular period. And that's why DCA works, whether you're a beginner or an experienced investor. Well, it's worked for me so far. So the next question is, where do you begin dollar cost averaging? Well, I have to say, one of the best places to start doing this is by using ETF. Now, let's talk a little bit about ETF. What is ETF? ETF is also called Exchange Traded Fund. And again, it's an excellent choice whether you're a beginner or either experienced investor, because it allows you to invest in a diversified portfolio of stocks, bonds, or other assets without the need to pick and select individually. So instead of spending a lot of time to guess which stock can perform better, to try to get news, to know what's going to be happening and stuff like that, well, ETF saves you that trouble and it gives you the exposure to a broad range of companies and industry, therefore spreading out your risk. Now think about it, DCA is all about spreading out the risk of time, and ETFs is about spreading the risk of assets. Let me give you an example, like the S&P 500 index, the VOO or the SPDR or IVV. These are counters that you can find on the American stock market that tracks the S&P 500 index. Yep, they're all tracking the same thing, it's just by different companies lah. So how does this work? It tracks the top 500 company in the US stock market. This includes stocks from many industries, such as big tech firms like Nvidia or Amazon, or even healthcare like United Health, or even energies company like ExxonMobil and so on. As long as you're in the top 500 company list, they will track the performance of all these top 500 companies, therefore making it a very diversified portfolio to invest in, suitable for all beginner investors or even experienced investors. Since it's so diversified and it tracks the top 500 companies, what happened is you do not need to be too worried about individual company how they are doing, but what you need to pay attention to is merely the macro trend of the environment, and generally this is something that's rather safe. So think about a country like US. Generally, whether you like it or not, they are still going to be one of the biggest nation and biggest economy in this world for the next coming decade. So as long as they are performing well, the overall economy is going to be doing well over long term, it makes them a solid investment. Instead of needing to be worried whether the AI bubble trend is going to burst or not, or maybe energy is going to be attacked or not, or either renewable cost is going to be a next trend, you don't have to think about all this. You just need to know one thing: whether overall economy is it gonna do well. Another reason why many people like to use ETF is this: it is low cost. Think about it, if you were to buy one stock out of all 500 companies, how much money you need to spend? So when you buy an ETF that is tracking the S&P 500, you're paying so much lesser. With that low cost, you already have so much of diversification. And one more thing is fee. You get to save a lot when you invest in ETF when it comes to fees, because again, ETF is all about low cost, and all these fees could eat up to your return if you're not paying attention. So now habis liao, can go out and invest in ETF? The question now will be, where do you invest in ETF, kan? Well, one of the easiest way to invest in ETF today is actually through robo-advisory app like StashAway. We've heard of it for a very long time. This is one app that makes it really easy for anyone to invest in a diversified ETF portfolio. Instead of investing in one ETF only, what they do is that they help you pick and select the right ETF for you according to your risk profile. So within your portfolio, there could be S&P 500, there could be tech-specific ETF, there could also be country-specific ETF. All depends on what kind of risk portfolio are you choosing. Now, it also allows you to do one thing, which what we talked about earlier, which is DCA. Now, just by signing up with the app, what can you do is that you can select this auto transfer. So every month, you can just invest regularly without needing yourself to trigger it manually. That way, truly, you can invest with no headache, right? Like they say, the best way to invest is just invest and forget. Now, if you don't believe me, you go and Google. There are many cases where people forgot that they have invested and they make a lot of money after many years. Now, one more thing, if you are someone who wants to learn more about investment as well, StashAway also provide regular updates from their CIO, Chief Investment Officer, where they will give updates about the market and so on. Therefore, you know what's really happening in the market and how are they making certain decisions. On top of that, as usual, ETF is all about low fees. Yeah, and that is something that they specialize in. Here's the thing, right? Recently I went and checked online to see how are all these robo-advisors performing, and especially when it comes to StashAway. I found rather mixed comments from users. Some are happy with the result and some are not impressed with their performance. Let me give you this example. On Reddit, This one guy said, I've been using StashAway over a year, but my returns are underwhelming. I could have gotten better returns if I just picked my own stock. So before I even suggest that you all take a look at StashAway, right, I decided that this time, maybe what I'll do is that I will talk to StashAway and I try to get their performance result, right, to see whether are they good or are they bad. Is it still worth looking at them? After all, there are so many options these days. And that's what we did. We reached out to them to get their performance records. Because we wanted to see that if, let's say we talk about investing in ETF is really so good, right? So why still got all this complaint, right? And we managed to get a hold of their historical data for their 36% SRI portfolio, which is the most risky portfolio that's equivalent to 90% equities. Now, according to them, it has been performing at 9.9% per annum return since inception. If let's say that is the result, everyone should be very happy with. How come still got people complain one? So after deep diving into the data, here is what we found. While ETF is good and regular investing is good, the result will still depend on another factor, which is how much time an investor stay invested. Now, take a look at this. If you only invested in 1 month, there is a chance that 37% that you will be losing money. Because the market go up and down, right? Sometimes make money, sometimes lose. And 36% of the time, it is losing money. 64% of the time, making money. So it depends on which day you go in. The day you go in is a day that perform negative, then sorry lor. Or either the day that you buy in already, next few days negative, then sorry lor. But if you buy in already, next few days positive, then congratulations lor. So that's probability, right? And that is what happened. So here's the thing. Apparently, investors who have negative return in their first month are very likely to withdraw and leave the platform. So imagine this. First month when you invest, you lose money, and there's a very high chance you will just say this app is not working, ETF is not working, therefore you just withdraw all your money or stop investing altogether. Well, not surprised that these people will not be too happy. Okay, now you're thinking,
huh? Sure not. What if stay longer invested leh? What if you DCA longer leh? Will it really make money or not?
Here's where we took a look at their record of people who have invested for 1 year all the way up to 3 years. Well, this is what we realized. The longer you stay invested, the chances of making a profit in your investment increases significantly. People who invested about 1 year period, their chances of making a profit is 73%. Remember earlier, if you only invested in 1 month, your chances of making profit is only 64%. Because now, more up and down, then there's more ups to play with, right? And people who are invested for 2 years period have a 77% chance that they will make profit. And people who invested about 40 months, which is around 3 years, they will have 92% chance to make profit. Means only 8% of the time, the chance of their portfolio will be in negative. So to make things simple, the answer is clear. As long as you stay invested longer, there is a higher chance of you coming out of it with a profit than making loss. But the shorter time you stay, the higher chance of you losing money. Now you must be thinking,
maybe this one is StashAway provide punya result. Obviously, it is fake law. They try to tailor it ma.
Well, let's not look at StashAway then. Let's take a look at the S&P 500 20 years performance. Now, as you can see from the year 2000 all the way until the year 2024. From what you can see here is that you think about it, if you muscle at 2000 honestly, if you entered at the peak that time, wait until 2004 also you losing money. How stressful you will be. How many people can really tahan with that emotion and just say, oh, I'm going to continue investing? I bet many people chao liao lo, But if they stay on all the way until 2016, ho se liao. And then if they stay on longer until 2024, today, they talk also louder than people. Wind also stronger when they walk. But think about it this way, imagine you invest in 2008. Then within 1 year you say, walao, jialat, this market drop until like that. Then you chao liao. Then after 20 years in 2020, your friend say, friend, I make money, deal. Then what you do? You cry yourself, lor. Nah, so my point is this. At the end of the day, when it comes to investing, it's all about emotional management. If you panic buy, panic sell, I can tell you it won't end too well. So the key lesson that I want to share with you is this. You have to stay invested in long term to reap the benefit. More often than not, successful investment is more than just strategy, but also emotional management. And I can't help but to tie back into this. Dollar cost averaging help you to diversify the emotions as well. Because instead of investing one shot and need to decide whether this is the best time and you throw in all your money, you can choose to spread it out over many months. Imagine if you have 100,000 ringgit. You can spread it over, say, 100 months. Every month, 1,000 ringgit. Less stress, true or not? You can also spread it to 10 months and 10k, 10k, 10k. Any way that you prefer lor. No right, no wrong. But before we go, I want to handle a few objections first. The first thing that I want to tell you is this, those who say,
I don't like do dollar cost averaging because right now I got one lump sum.
my answer to you is very simple. If you got one lump sum, you want to put it in now, it is okay one, 没问题. But usually I suggest you break it into smaller pieces, maybe 3 portion, 5 portion or something like that. You have to remember this one thing, right? Your wealth doesn't just stay stagnant one. It's like today you got 100,000 to invest. Next month you got no income, man. Next month when you receive your salary, the time you got more money, man. You also need to think about how to invest, man. This coming year end, you got new bonus coming in again. That is extra money again, right? So you also need to think about how to allocate it. So the truth is, whether you like it or not, dollar cost averaging will happen in your lifetime because your wealth will keep growing. Now, unless you don't work and then all your money is inherited law, so you inherited 1 point, then you just need to manage that lump sum. If not, for most of us, dollar cost averaging is just gonna happen naturally for you. It's just whether over a period of 1 year, 1 month, 1 week. It all depends on yourself. One more last question. This one, every time people ask me, I very 头条one. People say,
Wow, bro, the market going up, should I still dollar cost average? I only want to dollar cost averaging when the market going down.
usually people ask me this, I a bit 傻眼 in Chinese say. Yeah, you know why or not? Bro, dollar cost averaging is a system. You don't care whether price go up, go down, you continue investing. If you only dollar cost average and the market going down and market go up, you don't want to dollar cost averaging. That is called timing the market. That is not dollar cost averaging, friend. So I hope today's video will help you make a better investment decision and help you guys to kickstart it and not FOMO during this bull market period. Okay? So as you move on here, I hope you hang on hard and make money. See you, bye bye.